Hi, I'm Bill Spalding. Welcome to WCS Money Tutorials. I see many YouTube videos promoting exchange-traded funds and stocks that pay high dividends, but are they the best securities to own right now? I have recently promoted long-duration ETFs based on U.S. Treasuries as one of the best investments when interest rates are high, as they are now. How do long-duration ETFs based on U.S. Treasuries compare, both in income and capital gains potential, with dividend ETFs? And how do both types of securities compare with the growth fund, like an ETF based on the NASDAQ 100 index? Long-duration ETFs and dividend ETFs both pay regular distributions. When interest rates are low, dividend ETFs suffer less from rising interest rates than long-duration ETFs. Long-duration ETFs will decline in price when interest rates rise, especially if interest rates are near zero. But when interest rates are high, long-duration ETFs should have a greater potential for capital gains. How much greater? This video will explore how these securities actually performed during a look-back period from the end of 2018 to February and March of 2020, when interest rates declined by 0.75% by February 2020 and by 2% by March 2020, the start of the COVID-19 pandemic in the United States. First, I will briefly discuss what duration is and how it relates to interest rates and to bond prices. Bond prices and securities, such as exchange-traded funds based on bonds, move inversely to interest rates. When interest rates decline, bond prices increase. Duration measures this interest rate sensitivity. Duration is roughly proportional to the term of the bond. Bonds with longer duration will change more in price than bonds with shorter duration. Therefore, bond securities will increase in price more when interest rates decline. Check out my video on duration to better understand this concept, which is important for investments. The link is provided in the description. Duration is a theoretical concept, but how do long-duration securities compare with high-dividend securities when interest rates decline? To see real-world results, I have chosen a test period from late 2018 to the start of the COVID-19 pandemic in 2020. From the end of 2018 until February 2020, interest rates declined by 0.75%. When COVID-19 became a pandemic, interest rates were further reduced to near zero, resulting in an interest rate decline of about 2%. As you will see, long-duration securities performed very well, even when interest rates declined by only 0.75%. They performed even better when interest rates dropped further at the start of the COVID-19 pandemic, while stock prices plummeted. There are many dividend ETFs. Recently, U.S. News published a list of what they considered the 7 best high-dividend exchange-traded funds. These funds had dividend yields ranging from 3.1% to 4.5% when the article was written. I have chosen 2 long-duration ETFs for this comparison: the PIMCO 25-plus year zero-coupon U.S. Treasury ETF and the Vanguard Extended Duration ETF. I chose these securities because they were both available during the test period, and they are both based on U.S. Treasuries, which are free of credit default risk. Choosing securities free of credit default risk is important because interest rates often decline because of deteriorating economic conditions, which may cause the credit ratings of bond issuers to decline, causing their bond prices to decline as their risk increases. I have chosen the longest duration ETFs because they increase the price the most when interest rates decline. I also wanted to compare the Invesco QQQ Trust, which is composed of the stocks of the NASDAQ 100 index, 100 of the largest companies in the NASDAQ, including Apple, Microsoft, and other large tech companies. These companies are usually the fastest growing, outperforming most companies in both the Dow Jones Industrial Index and the S&P 500. This chart shows the prices of these securities at the end of 2018. This chart shows prices on February 16, 2020, when interest rates declined by 0.75% before the start of the COVID-19 pandemic. This chart shows what happened when the Federal Reserve lowered interest rates to near zero to help people cope with the onset of the COVID-19 pandemic. Here you can see the price gain percentages for these securities. As you can see, the Invesco fund did a little better than the long-duration ETFs. But the long-duration ETFs did much better than the dividend ETFs, even though interest rates declined by only 0.5% for the period ending February 2020. Notice that the dividend ETFs with yields exceeding 4%, colored purple in this table, increased in price less than the lower-yielding dividend ETFs and the long-duration ETFs. Companies paying high dividends are not expected to grow much, since they are paying most of their earnings as dividends rather than investing in their business. But when interest rates declined to near zero by April 2020, the long-duration ETFs significantly outperformed the other securities, even the Invesco fund. Most of the dividend ETFs suffered significant losses. Again, note that the dividend ETFs fell in price more than the other securities, while the long-duration ETFs soared in price, gaining more than 65%. In fact, the ETFs paying the highest dividends fell the most. This makes sense, since companies that pay high dividends are not growth companies, and they often lower their dividends during financial turmoil, which lowers their stock prices. But looking at the short term right before the start of the COVID-19 pandemic, all the other securities except for the bond ETFs plummeted in price, while the long-duration ETFs zoomed in price. Part of the reason why the long-duration ETFs did so well is because of the flight to safety, to U.S. Treasuries or securities based on U.S. Treasuries that often occurs during market turmoil, when people actively search for safe places to put their money. The other reason why the long-duration ETFs did so well is because of the 2% drop in interest rates. As I stated earlier, bond prices go up more when interest rates drop more. Interest rates are now above 5%. So if they drop significantly again, because the economy is entering into a recession, or because of a war with China, or because of some other economic calamity, then these long-duration ETFs will zoom in price, while the other securities will probably suffer significant losses. And did I mention that these long-duration ETFs also pay a very decent income while you hold the securities? I do want to emphasize that you should select exchange-traded funds based on U.S. Treasuries or some other sovereign bond free of credit default risk, and not other types of bonds, because those bonds may decline in price if the bond issuers suffer financial distress because of the deteriorating economy, as often occurs during recessions. Another long-duration ETF is the iShares Treasury Strips Bond ETF. I did not include this security in the comparison because it was only created in 2020, so it was not available for the test period. But it should go up in price when interest rates decline, just like the other two securities. So what is the best way to buy these securities? These securities have been trading within a narrow band so far this year. Interest rates may rise a little higher, but it should not affect the prices of these securities very much. Prices may stay within this band for the rest of the year. Set limit orders to buy near the bottom of the band. Prices may go lower than your limit order, but don't panic. Prices will rise significantly when interest rates start declining, which probably will not happen until next year. Prices may rise even before the interest rate declines if the Fed is expected to start lowering interest rates to prevent a recession. You can see that the prices of these three securities correlate very closely. You can see from this graph that the prices are near the lowest they have ever been for these securities. The low point was reached on October 24, 2022. As you can see for EDV. EDV reached its peak in April of 2020 when interest rates declined to near zero because of the COVID-19 pandemic. Part of this increase in price is the result of the flight to safety that often occurs when there is a lot of uncertainty about the market. Here you can see the extended graph for the PIMCO security and its high point. So far this year, EDV has not dropped much below $84. GOVZ has not dropped much below $88. And the low point for the iShares ETF for this year was $12.60 per share. So wait until prices decline again to these low levels. Then consider setting your limit orders to no higher than these low prices. Of course, prices may rise sooner because interest rates are not the only factor affecting bond prices. So limit orders that are too low may not trigger. So you may have to adjust your limit orders according to new developments. You may also set limit order ladders, setting limit orders at various prices to make it more likely that at least some of them will trigger, while maintaining the possibility to buy some shares at lower prices. To summarize, when interest rates are low, then avoid long-duration ETFs because they will decline in price when interest rates increase. When interest rates are high, then long-duration ETFs based on U.S. Treasuries are a much better investment than high-dividend ETFs, because they will gain much more in price when interest rates drop, and this increase in gain can easily compensate for slightly lower distributions. When interest rates are high, then long-duration ETFs will more likely soar during economic turmoil, while most other securities, including growth securities, may suffer significant losses. But the increase in price may be temporary. Bond prices spike when interest rates decline, but then they fall back, so sell the price spike. Remember, interest rates are not the only factor affecting bond prices. Bond prices will still vary even when interest rates are not changing, but they won't vary as much as stocks. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.